Trump's devastating trade war weapons. The news last week was dominated by breathless headlines about the new trade war between the US and China. But this trade war has been brewing for years and came as no surprise to readers of my newsletter, Project Prophesy. In fact, the new trade war is simply a continuation of the currency wars that began in 2010. I've warned for over a year that President Trump's threats of tariffs should be taken seriously, while most of Wall Street discounted Trump's talk as mere bluster. Now the trade wars are here as we expected, and they will get much worse before they are resolved. The most powerful analytic frame today for understanding political and macroeconomic developments is the sequence from currency wars to trade wars and then ultimately shooting wars. Currency wars arise in a condition of too much debt and too little growth. Economic powers try to steal growth from their trading partners by devaluing their currencies to promote exports and import inflation. This can work in the short run, but the benefits are strictly temporary because trading partners retaliate by devaluing their own currencies. The tit-for-tat devaluations leave everyone worse off because of the uncertainty and transaction costs imposed. Once it becomes clear that currency wars are a failure, nations resort to trade wars. These begin with tariffs imposed by one nation on another to protect domestic industry and reduce trade deficits. As with currency wars, the problem is retaliation. Victims of tariffs impose their own tariffs and the world is worse off. We've seen this pattern before in the 1920s and 1930s. It began with currency wars, 1921-1936, then trade wars, 1930-1939, and finally a shooting war in the Second World War that began in Asia in 1936. Spread to Europe in 1939 and subsumed the US in 1941. The present currency war began in 2010. The new trade war began in 2018. Let's hope a new shooting war or even a third world war does not follow in sequence. Trump is like a five-star general in the currency and trade wars. It's important to understand his weapons and tactics. Trump likes to threaten to get results but often does not follow through on his threats. Recently he threatened to withdraw the US from the World Trade Organization, WTO, the primary multilateral body for settling trade disputes and a successor to one of the original Bretton Woods institutions, along with the IMF and World Bank, established in 1944. But Trump's threat to withdraw from the WTO will not be carried out. It's in the bluff category, strictly for show. The fact is Trump is turning trade policy upside down without withdrawing from WTO by using other tools at his disposal. There has always been an exemption from the application of WTO rules where national security is involved. It's just that past presidents have never used the authority because they are globalists, Republicans and Democrats. Trump's method is to weaponize national security considerations in the context of trade disputes. The US has always had ways to stop trade flows and restrict direct foreign investment based on national security considerations. Trump's three main weapons, mostly unknown to everyday Americans, are IEEPA, CFIUS and Section 301 of the Trade Act of 1974. IEEPA stands for the International Emergency Economic Powers Act. Enacted in 1977, it allows the president to regulate commerce after declaring a national emergency. He can declare this emergency to deal with any unusual and extraordinary threat, which has its source in whole or substantial part outside the United States, to the national security, foreign policy, or economy of the United States. CFIUS stands for the Committee on Foreign Investment in the United States. It began under President Ford in 1975. CFIUS gives the executive branch power to monitor the impact of foreign investment in the United States, and determine if it jeopardizes national security. It can block acquisitions of U.S. firms by Chinese companies, for example. Section 301 of the Trade Act of 1974 is the nuclear option when it comes to trade wars. I don't want to get too deeply in the weeds here, but Section 301 gives the president broad authority to impose sanctions and penalties. It gives the president a free hand to impose billions of dollars of damages if not more on China. So Trump has the best of both worlds. He can threaten the WTO, but doesn't actually have to withdraw because he can get everything he wants anyway using IEEPA, CFIUS, and Section 301. The globalists are freaking out but can't stop him. Unlike previous globalist presidents, Trump is a nationalist. And he's using these powers like crazy to push his agenda. The Congress can't stop him because all of these weapons are statutory. They were already passed by Congress in the 1970s and 1980s. These statutes delegate expansive powers to the president. What's new is not the law but the way the law is being used. Weimar Republic hyperinflation. During the Weimar Republic hyperinflation in 1922-23, paper money became worthless and was swept down sewers, left, below, or fed into furnaces as fuel, right, below. The currency wars continued with French devaluation, 1925, UK devaluation, 1931, and US devaluation, 1933. When the currency wars failed to produce growth, the trade wars erupted with the Smoot-Hawley tariffs, 1930, and similar tariffs from U.S. trading partners. After currency wars and trade wars failed came shooting wars in Asia, 1936, and Europe, 1939. The same pattern is repeating today with a new currency war, 2010, and trade war, 2018. There is legislation pending in Congress right now to amend CFIUS. The name of the bill is the Foreign Investment Risk Review Modernization Act, or FIRMA. This amendment to CFIUS will give CFIUS greatly expanded powers to stop Chinese takeovers of U.S. crown jewels in technology, telecommunications, and the defense sector. This new law shuts the Chinese, and anyone else Trump doesn't like, out of the market to acquire U.S. tech and defense stocks. Once you remove the biggest buyers from the market, prices will plunge to reprice to the new reality. With the trade wars and pending legislation in mind, what are my predictive analytic models telling us about the prospects for a stock market crash in the tech and defense sectors? Right now my analytical tools are telling me that FIRMA is close to a sure thing to become law, but Wall Street is underestimating the impact of this on takeover activity and stock prices to tech and defense companies. FIRMA has been attached to the National Defense Authorization Act, NDAA, for fiscal 2019, starting October 1, 2018. However, Congress will be in recess most of the time after July 26 for vacations and midterm election campaigning. NDAA is must-pass legislation. This means Congress has to pass this before the end of September unless they enact a continuing resolution. I estimate 2 possible outside dates for this to become law and go to the President for signature: Sunday, September 30, 2018, with no continuing resolution, or Thursday, December 13, 2018, end of this session of Congress. Of course, markets won't wait until then to react. Sooner than later, Wall Street will see this coming and start to discount the impact. FIRMA has bipartisan support from liberal Democrats and conservative Republicans. It's as close to a sure thing in D.C. legislation as you can get. China will not take this lying down. They are fighting back in the trade wars using currency war weapons as shown in the chart below. They will also retaliate directly by restricting U.S. investment in China's technology, another blow to global tech stock prices. Chart. China is fighting back in the trade wars by returning to the currency wars. When Trump imposes a 25% tariff on Chinese imports, this increases the costs of Chinese goods to U.S. consumers. But China can retaliate by cheapening its currency, CNY, against the U.S. dollar, USD, which reduces the costs of Chinese imports to U.S. consumers. That's exactly what China has done the past few weeks with a bigger yuan devaluation than the August 2015 shock devaluation, as shown in the chart below. The CNY/USD devaluation offsets the tariffs. The trade and currency wars continue and will get worse. The trade and currency wars are like a hurricane aimed directly at tech and defense stocks. Wall Street does not see this coming, so there's an excellent opportunity to profit by positioning in advance. Regards, Jim Rickards. currency war, then trade war is shooting war next? My thesis is that currency wars are followed by trade wars and then finally shooting wars among major powers. This happened in the 1930s and it seems to be happening again. Currency wars begin in a condition of too much debt and not enough growth. Countries steal growth from their trading partners by cheapening their currencies to promote exports and import inflation. The present currency war started in January 2010. The problem with currency wars is that all advantage is temporary and is quickly erased by retaliation. Trading partners retaliate with their own devaluations. Currency cross rates end up back where they started, with costs imposed due to the uncertainties. Not only is the world not better off, but it is worse off because of the costs and uncertainty resulting from the currency manipulations. Eventually, the world wakes up to this reality and moves to the trade war stage. Once countries realize that currency wars don't work, they turn quickly to trade wars through tariffs and other trade barriers. The problem is that trade wars don't work either. For the same reason currency wars don't work, retaliation or tit-for-tat tariffs soon puts everyone back where they started. The new trade war started in January 2018 with the announcement of tariffs, and those tariffs actually began to take effect last week. Just because trade wars have started does not mean the currency wars are over. Not at all. The currency wars and trade wars continue side by side. In fact, they are related. If the US puts tariffs on China, which we have, then China can fight back two ways. The first is to impose their own tariffs on US exports, which they have. The second is to cheapen their currency to offset the impact of the tariffs. If the US imposes a 25% tariff on China but China cheapens its currency by 25%, then everyone is back where they started in terms of the costs of Chinese goods to US consumers. This would be a potentially devastating development for markets. A shock yuan maxi devaluation will be the shot heard round the world as it was in August and December 2015. Both times, US stocks fell over 10% in a matter of weeks. There are individual winners and losers from the currency and trade wars, but the global economy as a whole is definitely a loser. This new trade war will get ugly fast and the world economy will be collateral damage. I believe it will get much worse before it is resolved. We should look for slower growth and possibly a recession as the trade and currency wars play out. Let's hope that history does not repeat and that we don't end up in a third world war, as the currency/trade wars of the 1930s helped lead to World War II. Regards, Jim Rickards.
Well, there's a huge problem of imbalance, but it is not the result of bad trade deals or NAFTA or the WTO or what the USTR was negotiating. This has been going on for 30 years. We've actually had 43 straight years of large and growing current account deficits. That's a monetary issue. It's due to the kind of policy we've had from the Fed and the fact that we've inflated our costs, our prices, and our wages much more rapidly than some of the competitors in the world like China and the others. That's what's created this deficit. So a trade war is not going to solve it. If he wants to solve it, he needs to stop talking about tariffs and call up the Fed and tell them, let interest rates find the right level and we'll begin to adjust this problem over time. Right now, I would say that we have an absurd policy, dangerous, stupid, the worst that I've seen since my whole career started in 1970 under Nixon, and he did some crazy things.
And yet the market is marching to new highs.
Well, the market marches to new highs until it doesn't. The market basically fears nothing except maybe a central banker might look at them cross-eyed, but central bankers are too chicken to do it. Now, the fact is, we are heading to a massive trade war in the world because Trump doesn't know what he's doing at all. He's making it up. He's a hopeless protectionist with a 17th century view of the world. There is no tariff problem in the world. The average tariff in the world today is 2%. It's nothing. The U.S. is 1.7.
But it's fair to say, David, irrelevant of whether he focuses too much on the trade deficit as a tool to explain to his base why he's doing that. If we ignore that, it is fair to say that it tends to be emerging markets that place more tariffs than developed markets, and China once was a small emerging market, no longer is. The terms of trade with a country like that do need to be rebalanced somewhat compared to 20 years ago.
I doubt it, because in 1990, when they decided to go the export route, their average tariff was about 30%. The average tariff in China today is 3.5%. It's not an issue. What they're objecting to is China's policy of no ticky, no washi. In other words, if you want to come to China and do business, you have to be in a joint venture and share your technology. Well, I say, so what? If somebody wants to go to China so they can come on CNBC and brag that they're in a growth market, then they ought to put up with the local regulations. But don't start a trade war and throw the soybean farmer under the bus because some big business lobby in Washington is whining, about China's terms of business.
Technical divergence successfully maintained. In an update on gold and gold stocks in mid-June, we pointed out that a number of interesting divergences had emerged which traditionally represent a heads-up indicating a trend change is close. See, divergences emerge for the details. We did so after a big down day in the gold price, which actually helped set up the bullish divergence. This may have felt counterintuitive, but these set UPS always do. Consider now the updated chart below. We have added the Huawei gold ratio in the third panel of the chart, as it provides additional clarity. Everybody has different reasons for wanting to buy or hold gold. This is actually a fairly good one. Smiley face. Gold. The Huawei index and the Huawei gold ratio, it was a close shave. But the Huawei did not violate its previous low and the divergence with gold was therefore maintained. This is even more obvious in terms of the Huawei gold ratio, which would have made a higher low even if the index had not. As the chart illustrates, after our update, gold and gold stocks continued to head down for almost 2 weeks, but readers watching the sector no doubt noticed that one gold stocks declined only reluctantly and the sector exhibited internal strength, i.e., even on down days, numerous stocks managed to gain ground, and 2. The divergences we discussed remained in place. Since then, there was a minor bounce in the gold price from a lateral support level created by the December 2017 low, but the relative strength in gold stocks has continued to increase, which is a clear change in character. The Huawei gold ratio even managed a kind of breakout by moving above a lateral support resistance line formed by a previous low and 2 previous highs, to the extent that one can even speak of support and resistance with respect to ratio charts, which is debatable. Note that the Huawei gold ratio was in a fairly strong downtrend for more than 6 months before bottoming very quietly in mid-March. Obviously, not every upturn in the ratio will lead to a significant trend change. The ratio often expands in the short term in the course of gold price rallies, such as in the rather disappointing seasonal rally that began in mid-December. In that case, it was actually the weakness of the expansion in the ratio that proved to be a heads-up. The recent case is different, as the ratio has begun to strengthen noticeably in a time of weakness in gold and silver prices. Having said that, the Huawei index itself is now facing overhead resistance both from previous price highs and in the form of its still declining 200-day moving average. While prices have moved above the 50-day and 20-day MA, the latter has not even crossed back above the former yet, and both have only just begun to flatten out. If one squints a bit, one can see minor divergences between the index level and the RSI and MACD oscillators. All in all, the recent advance still looks a bit dubious from a technical perspective. It would therefore not be a big surprise if the recent rally were to stall out near current levels and was followed by another consolidation phase before a breakout attempt. A successful breakout above lateral resistance and the 200-day MA is ultimately required to confirm the positive message from the divergences at the recent lows. Per experience, the more forceful such a confirmation is, the more reliable it will be. This refers specifically to the moment of confirmation, regardless of its precise timing. Considering the lengthy bottoming period from mid-2015 to early 2016, and other historical examples, one has to be mentally prepared for the possibility that it could take a few more weeks or even a few more months before a new medium-term uptrend emerges, but it could just as well happen right away. For long-term oriented investors, this should be irrelevant. Unless one has the patience of a Zen master, one should not be dabbling in this sector anyway, but short-term traders have to be vigilant, as a potentially worthwhile opportunity continues to be in its formative stages. Hui Daily, with moving averages and near-term lateral resistance penciled in. Mildly positive divergences with oscillators are in evidence, but major resistance still has to be overcome. Note, when it finally happens, it will happen fast. At that point it is usually best to abandon any remaining reservations. A positioning extreme. Apart from the improving Hui-gold ratio, there is another signal that indicates that traders should be on alert. Since 2007, the CFTC is publishing disaggregated commitments of traders' data in addition to its legacy COT reports. We are keeping an eye on the managed money category in this report, which primarily consists of speculative trend followers, mainly CTAs and hedge funds. This group has held a net short position in COMEX gold futures on just 3 occasions in the entire history of the report. 2 of those were recorded in 2015, one in the middle of the year and one right at the December low, after which a scorching rally ensued. In about 6 months, gold rallied by around $330 from its low. The XAU gained 200% and the Hui 180%. Due to last week's holiday, the most recent update is already a bit dated, June 26th, but it was just the 3rd time the managed money group went net short in the aggregate, if only by a handful of contracts. On the chart below, the net position is stated as 0, but in fact it was net short by 24 contracts. After the report was published, gold continued to decline at first. It seems likely that the net position of this group of traders subsequently went a bit further into net short territory. The managed money category in COMEX gold futures. Top panel, net position, black line, versus the gold price. Bottom panel, net position, black line, as well as gross short and gross long position, red and green areas. The red lines in the top panel illustrate that another significant divergence has emerged, in this case between net speculative positioning and price. We want to stress here that we are definitely not arguing that it is always positive when speculators go net short in this market. Very long-term data clearly suggest otherwise, i.e., context is important. In this case, context is provided by the recent improvement in the gold sector's relative strength against the metals and a likewise fairly recent minor shift in macroeconomic fundamentals, which look now slightly more favorable for gold than previously. As the chart illustrates, the net speculative position is also increasingly diverging from prices this year, after having tracked them fairly closely from Q3 2015 until Q4 2017. Clearly, this market is now potentially quite susceptible to a change in perceptions. In the next missive we will discuss the change in macroeconomic fundamentals alluded to above and also take a brief look at gold versus real interest rates and inflation.
Still the best game in town.
Because the rest of the world is lagging behind. I think one of the reasons why is that we've gone forward with deregulation, with tax cuts, and this has enlivened the U.S. economy vis-a-vis the rest of the world.
Enough that we can take any of these trade hits?
For now, it seems as though we can. Let's, not forget that we are running a trade deficit. So if anything, who knows, perhaps a trade war might be either neutral or a slight net benefit to the U.S. economy. It's these countries that are running huge trade surpluses. That's where you find the equity markets are down sharply since the latest outbreak of trade tensions for the year to date.
You would?
I would. And, if you're keeping score, look at our markets. We're up a little bit on the year. Look at China, down pretty significantly. And they enjoy the trade surplus. They're going to probably... they're running out of runway as we speak. And I don't think there's any investor out there that likes, the trade discontent and the rattling of sabers. But I agree with the president. There are some real issues here, and the global trade system is broken. And it's not just the industrial marketplace where intellectual property is being robbed. Look at China's J-31 strike fighter. It looks exactly like a Lockheed Martin F-35. If we don't do something now, when will we do it?
Yeah, that's what I keep saying over and over again. I mean, my concern, John, is that if you allow this to continue with completely unchecked, then you're not going to have the kind of economy that we have right now. You will lose that position to China.
That's exactly right. And the market believes that if it begins to sell off deeply in response to troubling news on the trade front, that would tell the Trump administration to go more slowly, to perhaps reconsider some of its positions. But as it stands right now, the U.S. economy is doing great. China's not doing that well. Europe is not doing that well.
So does that give us more ammunition, so to speak, when we're dealing with them in this trade war? And don't forget, we're their biggest customer. We're the world's biggest customer.
I think the president's actually getting some results. I think it was last week, you actually had German automakers go to their constituents, go to the politicians and say, cut a deal, make a deal. Yeah. And some people are actually talking about no tariffs, and that was teased by the president back at the G7 in Canada not that long ago. What would the world look like if we actually had lower tariffs across the board?
It'd be fair. I mean, then you could actually have a fair,
maybe that's the end game. Maybe that's the end game.
And I'm going to go ahead and predict that 1 year from now, there is going to be less in terms of tariffs and restrictions on international trade than you have today after this is
John and I aren't often on the same side of the page, but I agree with that.
Right?
Right.
I mean, that is an accomplishment. If he can say, I was able to lower these tariffs, I was able to secure our intellectual property in a meaningful way, because don't forget how much that's costing companies, that is something.
I don't think it's policy, Trish, that's the problem. If there's something I could fault, it would be the communication of the message. You can't have, like, Steve Mnuchin and Peter Navarro going out on opposing networks talking their book. Those conversations should be kept inside the Oval Office, where the commander-in-chief makes the decision in the end.
So walk me through that. So you don't so Steve Mnuchin's like, oh, he's trying to temper everybody's
you create a disjointed message.
Like, we're going hard after China. And it's like, wait, what's really happening? Is that
keep it inside the room until you have a deal?
Markets?
I don't think you have to put it out there.
Is that why we were down so much? You know,
certainly the uncertainty certainly fed it, and I think that's what investors were, reacting to, because the numbers are still pretty good. I think they're reacting to the uncertainty.
Go ahead.
Well, with reference to what you're talking about, in the past, we had trade deals. They were kept secret. Okay, the public didn't have any idea of what was going on when these trade deals were being put together. This is a lot different than we're having today. This is wide open, and everybody has, some knowledge of the issues that are being discussed and which goods are being targeted and so on. This is perhaps refreshing for a democracy. It's a big improvement.
I think it's great, and I say this as a business and economics reporter. I mean, sometimes I was once told in my career, don't say GDP on air. Please don't say GDP on air, because no one knows what you're talking about. I guarantee you people know what GDP is now, and that's because the president keeps talking about it.
You can pull it at a gas station, they know what that word was.
Right? I mean, but that is refreshing. People are talking about trade. People are talking about GDP growth. People are talking about the unemployment rate, and this is what we need more of, because ultimately people do vote their pocketbooks, and you want to hold these politicians responsible. I
think that's true, but I think the conversation should remain with the professionals, because what's happening, it's being debated in the media, and the media is out there.
I see what you're saying, because he's got members of his own team out there saying different things, and
that's a disjointed message. And I get
manage them a little.
I get the generals at times, they disagree, but in the end, one person has to make the call. Keep it inside of headquarters.
All right, I'm going to leave it there. Thank you so much. Good to see you both.
A beginning shift in gold fundamentals. A previously outright bearish fundamental backdrop for gold has recently become slightly more favorable. Ironically, the arrival of this somewhat more favorable situation was greeted by a pullback in physical demand and a decline in the gold price, after both had defied bearish fundamentals for many months by remaining stubbornly firm. The eternal popularity contest. The list of gold fundamentals that have improved is short, but at least there is now such a list. Credit spreads. European high-yield spreads have broken out to the upside. In the U.S., high-yield spreads are better behaved, we suppose mainly on account of the fortunes of the energy sector, but spreads on the lowest-rated investment-grade category, BBB, have also seen a textbook breakout to the upside. Emerging market currencies, stocks, and bonds have come under pressure on a broad front. This is not just confined to Argentina and Turkey anymore. Stock market volatility has increased globally. Bank stocks have entered a downtrend relative to the broad market. Commodity indexes remain in an uptrend, mainly driven by energy prices. U.S. federal debt is expanding surprisingly fast. This is happening amid a decline in federal tax receipts, which is astonishing in view of reported economic growth rates. Note that the most recent Y/Y decline in tax receipts happened in Q1, i.e., before the tax cuts came into force. The proprietary incrementum inflation indicator has recently switched to a full inflation signal, on June 28. This indicator is based exclusively on market price signals. Credit spreads strike us as the most important of these factors as proxies for the trend in economic confidence. Here is what the situation in European junk bond spreads and U.S. corporate BBB spreads looks like at the moment. European high-yield spreads and U.S. BBB spreads, textbook upside breakouts. Examples of historical trend changes in credit spreads and how they played out can be reviewed here. Credit spreads, the coming resurrection of poly. The last three charts in this article show credit spreads turning up after having been stuck at extremely low levels for extended time periods. These charts explain why we are referring to the moves shown above as textbook upside breakouts. The growth rate of the U.S. federal debt strikes us as fairly important for the gold price as well. Empirically, it often appears to be a major driver, although it could of course be argued that rapid surges in budget deficits and the federal debt are simply symptoms of the type of fundamental backdrop that is traditionally favorable for gold. What makes the recent trend particularly interesting is actually the fact that the prevailing economic environment is normally not associated with declining tax receipts and sharp increases in federal debt. On the contrary. And yet, federal tax receipts were down 4.5% Y/Y in Q1, continuing the weakness in evidence since Q4 2015. Federal debt and federal tax receipts, the former has resumed growing by leaps and bounds, while growth in the latter has turned negative again in Q1 2018 to the tune of minus 4.5% Y/Y, and that was before the tax cuts came into force. Real interest rates and the inflation question. As our readers are no doubt aware, actual inflation, i.e., the growth rate of the money supply, has slowed rather noticeably. This is normally considered gold bearish, but just as gold bottomed and turned up with the beginning of the rate hike cycle, normally also held to be bearish, it started to firm shortly after the downtrend in the true money supply growth rate got underway. There is no need to rehash in detail why this happened. The short version is, the gold market appears to be leading future changes in economic conditions and monetary policy by uncommonly long time periods in recent years. This has been the case since 2005. It seems to be more sensitive and forward-looking than any other market in this respect. It seems that market participants are anticipating the lagged effect of slowing money supply growth on risk assets and the economy and the eventual, inevitable, response of monetary authorities. Along similar lines, when QE3 was announced in 2012, the gold price started to decline in anticipation of the eventual end of debt monetization by the Fed and the beginning of a new tightening cycle, and yet, it still took more than 3 years before the first rate hike was actually implemented. Regardless of the length of this lead time, gold prices definitely respond strongly to real interest rates, or let us rather say, to market perceptions about real interest rates. The time shortly before inflation expectations change. Investors express their views on future changes in CPI through the prices they are prepared to pay for TIPS, inflation-protected treasuries. Since they are market-driven, TIPS yields are the best real interest rate measure at our disposal. Not surprisingly, there is normally a strong negative correlation between the gold price and 5-year TIPS yields. In the chart below, we have inverted the TIPS yield in order to make it easier to see what has recently happened. After maintaining a near-perfect negative correlation for quite a long time, depicted as a positive correlation above via inverting TIPS yields, note that the TIPS scale to the left has to be multiplied by -1 to make sense. Gold prices and real interest rates part ways in early 2017. Recently the gap has narrowed a bit, as both TIPS yields and the gold price have declined. Still, this particular indicator actually remains bearish at this point. There is another, less future-oriented way of looking at real interest rates, which consists of simply comparing the level of short-term rates administered by the Fed to the most recent Y/Y rate of change in CPI. While this approach has many flaws, it shows how far behind the curve Fed policy is in the here and now relative to CPI. Moreover, it allows for comparisons with data of the more distant past, when TIPS didn't exist yet. A tale of two eras. The chart below compares two eras, in particular the time period from 2010 until today, which obviously includes the 2011-2015 cyclical bear market in gold, and the 1970s gold bull market. Both are juxtaposed with the real federal funds rate, defined as the nominal FF rate minus CPI. Two eras compared: gold price versus the real federal funds rate 2010 to 2018 and 1970-1980. The charts reveal an interesting parallel, both during the 2011 to 2015 bear market and the 1974 to 1976 mid-cycle bear market. The real FF rate first reached deeply negative levels close to the peak, and then rose until it briefly eclipsed or touched the zero line. Both bear market periods incidentally generated almost identical losses, minus 45.5% in 2011 to 2018, minus 46% in 1974 to 1976. It is worth noting that the fundamental backdrop for gold became progressively less supportive for gold between 1976 and 1980, especially compared to the first bull market phase. And yet, the run-up in gold prices only became parabolic in 1979 to 80, with gold stocks ultimately projecting even bigger gains. Their peak lagged the top in the gold price by almost 8 months. The Barron's Gold Mining Index only topped out in September 1980, while gold concurrently made a lower high, at $720 versus the $850 peak of January 1980. The enthusiasm that characterized the secular gold price peak of 1980 was far more pronounced than that seen at the 2011 top, which looks more like a cousin of the 1974 mid-cycle peak to us. The divergence with gold stocks is particularly telling. In 1980, the more speculative part of the gold universe only topped after the more conservative one. This is precisely the behavior we tend to see around major stock market peaks as well. These are usually marked by the more speculative Nasdaq stocks topping well after the DJIA or the broad market. While we would caution that things don't always have to play out the same way, all of this suggests to us that the probability that the secular bull market in gold still has further to go remains relatively high. At major bubble peaks, the irrationality of the herd tends to become palpable.